right, welcome back to the show. Today, I want to talk about kind of what I'm seeing in the market. Talking to other investors, I have quite a few investor friends. A lot in storage, but also a lot in not just storage, but a lot of friends that own single family rentals. They do fix and flips, commercial spaces, industrial, Airbnbs, you name it. So I've got kind of covers a lot, mostly every asset class in real estate. And by the way, these are my opinions. This is not financial advice or investing advice in any way. But I thought it'd be somewhat beneficial just because the variety of people that I talk to and associate with and network with, it may be good to kind of, just lay out everything that I'm seeing as of right now, which I think this will air. When will this air? First or second week of September. And I'm recording this end of August. So take it for what it's worth. Things could change the next couple of weeks, especially with I keep hearing interest rates are going to go down maybe twice the end of this year, and we're talking about the prime rate. And I am not a financial expert. I do my best to keep up with the things I need to keep up with, but I also don't like to get too much information because I think it paralyzes you in some ways. So, but back to the prime rate, my understanding is that's more short-term loans. So think like car loans, stuff like that, where it's 5, 6, 7 year loans. Those interest rates could move a little bit, which overall could impact, could impact Fannie, Freddie, which is home buyer loans, and could impact commercial loans, which are more, for the most part, more correlated to the treasuries. And I'm not going to dive into all those things right now. I am not a financial expert again, but I know a little bit about it. I know enough to kind of make my business work. And for me, and actually I was going to get into that. For me, that's worked. I try not to get inundated with information, especially information that doesn't pertain to me or that may slow me down or again, paralyze me. And I see that a lot with especially people trying to get in the real estate. They think they have to know everything. That's not the case. Get to know a few things that you need to know, and then take action, and then kind of stay in your own bubble in a way, in your own world. And I think that's where two things. I think that's where the successful people have success. I also think that's where people stay probably happier, right? If you're just focused on what you're doing and your bubble and your world. And obviously you've got to look for market trends, especially in your bubble, in your world, in your niche, whatever it is. But it is, I think two things. I think you can become more successful just because you're focused on what you're doing. And also you probably stay happier, right? You're not getting inundated with information. In fact, there's a podcast I listen to that, not going to name the podcast, but there are usually 3 or 4 hosts on this podcast, and it is real estate investing. There's one person on that podcast that seems to get inundated with information and almost has, and I don't know the guy personally, but just coming from the listen to him podcast, seems like a lot of what he says, what he does comes from fear-based, and probably limits him in some things he does. I could be, completely wrong there, but kind of back to my point is I think it's important to stay in your niche and stay in your own little world. So kind of got off track there, but did hit on some points that I wanted to kind of lay out there. But my thoughts kind of on the current market, whether interest rates go up or down. I don't think they'll go up in the near term, but I do think there's maybe a quarter point coming up, rate change, reduction, probably towards the end of this year. Maybe 2 of them, who knows? To me, again, it's somewhat good to know these things, but don't let it affect how you're investing. Continue to do deals. So what I'm seeing is, especially with all this, because we've had a lot of changes mean, this is, towards the last quarter of 25. You can take it back at least 2 years, maybe 3 years of a lot of uncertainty in the market, especially if the interest rates they've gone up, right? They've basically doubled since I think 2022, mid 2022. I think I had some loans that were sub 4 for about 2 or 3 years between 19 and 22. I was getting loans that were right around 4%. So there are loans that have almost doubled that interest rate, which just means you got to find better deals, right? You got to keep hunting. You got to find better deals. And you've also got to find other ways to make it work, which is something I want to get into in a little bit. I'm not going to drop it right now, but yeah, I think there's a lot of people sitting on the sidelines because there's a lot of uncertainty, which to me is a great thing. And I've been seeing this for a few years, where less people are really taking action and doing deals. There's still people out there looking for deals, but a lot of people passing by, just, kicking the tires and not taking any action. And I'm going to go into a few reasons why I think that is. But one is uncertainty and people kind of waiting for whatever, the government, Fed to change interest rates. They think that's going to heal all their problems, among other issues. But yeah, a lot of people are sitting on the sidelines right now, which means less competition for you and I, for people that are buying. And when I say that, I have not bought a deal since it's been a year and a half. But I've been working on a couple deals, 2 or 3 deals, we'll call 3 to 5 deals I've had to pass on, maybe more than that. Just didn't make sense. Maybe made sense with 4% interest rates, but that's not where we're at. But with that comes a lot more creative strategy, financing strategies. I've been offering a lot more seller financing options. I've done quite a few of those dating back to, I think my first one was in 2020, I believe. And that's, it's a great tool. Obviously the seller's got to be on board, and you also have to do a good job of explaining it and in a way selling it to the seller. It can be a win-win for both parties, but you got to know what you're talking about, or at least know a little bit to explain to the seller. And ideally you want to try to explain it at like a second or third grade level, so anyone can understand it. But yeah, back to my point, there's just less competition, less people doing deals right now, even listed deals. I talk to people all the time saying they can't find a deal. I'm like, well, are you looking at deals that are listed online? They're like, yeah, I'm looking at them, but nothing makes sense. And I'm like, well, have you made offers? Have you tried to, move the terms around and see if you can maybe do seller financing with a different interest rate, different amortization, different down payment, whatever it is? I just think there's a lot of people that don't think outside the box, and they think the only way they can do it, taking down a deal, is through bank financing, or maybe even raising money. But yeah, a lot less people, but more opportunity for creative financing, which is, to me, I would rather go down that path anyways. And we're still waiting on, it's getting closer, but sellers are still thinking their properties are worth 2022 values, 2021 values, where obviously they aren't, because as interest rates increase, values decrease. And that's what's happened. But sellers and buyers, I do believe, are getting closer to kind of be on the same page on value. So that's a good thing. I think each year, each quarter, whatever, half year, whatever you want to call it, we keep getting closer and closer and closer. But we had such a huge buildup in between 20 and 22 of values that just skyrocketed. You didn't have to do anything, and values just doubled. And I'm with self-storage experience, I can attest to that, but that was with a lot of things. Residential, right? A lot of residential doubled in that amount of time, and other commercial assets too. I also see that, just in general, and this is due to inflation, but people are tighter. There's not a lot of people don't have just excess money to spend. I think each year as it goes by has gotten progressively worse. From what I'm seeing, it seems like less people are taking vacations, and all that plays into being less comfortable or having less money to invest in deals. When money was cheap, and when I say money was cheap, financing was cheap. From 20 to 22 of those 2 or 3 years or so, people could do deals. People could borrow money for a lot cheaper. And really, you could borrow money at a less percentage than what inflation was increasing. So technically you were, it's what do they call it? Price arbitrage or whatever. But yeah, basically you were borrowing less than what inflation was going at. Now inflation's gotten under control and going the other way. So that's helped. But even if you're a full-time real estate investor or you're working 9 to 5, I think things have gotten tighter. Expenses have gone up. And I know for myself in self-storage, the way for us to kind of offset that is with value adds. And there's a couple different ways there. One is raising rents continuously, not just street rates, which you have to do, but also current renters rates, which is something that I know myself is probably a weakness. I should probably take out probably. It is a weakness. We're in smaller towns. So we don't want to go in and just completely bombard people with rent raises. We try to keep up on them. But those people are tighter, have tighter budgets as well. So a $10 increase, $20 increase on their storage unit per month could be a deciding factor if they're going to keep the unit or not. So I do think you need to do those things, the value adds with increasing rates, especially. But I think at times you also have to be smart about it and not lose, especially your good customers that have been paying. They don't go to auction. They pay every month. Sometimes less turnover with those people is better than raising them by $5-10 a month. I know there's difference of opinions there. I do my best to kind of walk that line between raising rents and keeping our good customers. But yeah, the other value adds are, for self-storage, adding tenant insurance, making sure it's mandatory. Obviously owners get a cut of that, but it also protects the renters. I don't think that's talked enough about. And I'm not going to dive into that. I'm not an insurance agent, but it's definitely benefit for the renter, benefit for the owners. Another thing that I'm seeing more and hearing more are kind of a couple things, but syndicators are having a tougher time with their deals, especially the ones that they signed up with short-term debt, which a lot of syndicators do because you're trying to pay off your private money that you borrowed, and I know it's across the board, but probably within 1 to 5 years. So these investors signed up for short-term money, and if they got rates, they could have gotten interest-only rates in 22 or 2021, and super low rate, or maybe they just got a super low rate for a 3-year term. I know myself. I had one loan product that was a 3-year rate adjustment, and I've closed on that in 22, I believe. Shame on me. I didn't know that was a 3-year rate adjustment. I thought it was fixed for 25. They never explained it to me. Shame on me for not checking the small print. But long story short, my rate went from, I was able to get it down lower, but went from, what was it at, 4.5% to now 6.5%. And this is a multi-million-dollar deal. So the cash flow that we lost was somewhat significant, especially when you're just talking interest, just wiped out, just out the door. But, I saw that on a small scale. There are a lot of people, especially in commercial space, not just storage, but commercial in general, that have much bigger problems than me, to where, their rates are doubling. Maybe they weren't cash flowing as much, and then their rates double, and now maybe they're not cash flowing at all or negative cash flow. And that's happening quite a bit right now. In fact, I know I have a buddy that he's been in touch with some banks and letting them know, like, hey, do you have any foreclosures coming up or some owners that can't operate their facilities? Let me know. I'd love to take over the loan and hopefully operate it the right way and make it work. But there are a lot of commercial foreclosures or commercial pain happening and coming. I'm seeing it. I'm hearing it. It's happening. But that also means we're in part of the cycle right now to where foreclosures are happening. So who knows how long that will go on. But that also says that we're at the end of a market cycle. And then the next market cycle is, values dropped and it's, I won't say it's easier to buy, but values have dropped. To me, you can buy in any market. Doesn't matter when. It doesn't really matter when you're buying. It's more about your strategy. So yeah, I've covered a lot of this. People are scared. Whether it's the news going on, politics, whatever. People are scared and afraid to take action. There are, from what I'm seeing, a lot less people, especially in self-storage, a lot less people getting into self-storage as an investment, a lot less people getting into investments in general. I mean, I remember in 21, 22, COVID was, I guess, still somewhat affecting us. But I remember, you go to the grocery store and you hear people talking about real estate investing. That's not good, right? You don't want that many people in it. And you always hear when that many people are talking about it or talking about something that you're in, you kind of want to go the opposite direction. But yeah, it's completely opposite now. There are less people. There's still people talking about it, but a lot less people taking action. And what I'm seeing is there's more people. It was weird. We went through, and I've been in several masterminds, probably a few hundred people, and mostly real estate investors. So I've seen kind of a lot of people nationwide, a lot of real estate investors nationwide, seeing what they're doing. It's really interesting. Quite a few, especially syndicators, and I'm not picking on syndicators, but it seems like things have gotten tougher. So I've seen real estate investors, if they're in, buying apartments, they see a shiny object. They're like, you know what? Apartments aren't working right now. Let me go to self-storage, or let me go to industrial, or let me go to triple net, whatever it is, car washes. I saw a lot of that going on. People just switching niches, trying to find the next best thing because the asset class they were in isn't performing as well. To me, that's when the people that double down at that point in their niche are the ones that are succeeding and will continue to be successful, because not only are they going to continue to find deals because they're staying in their niche, but they're also learning how to operate better. Hopefully, that's the plan at least. But I just think the more focused you are, especially on your niche, the better off you'll be, short term and long term. And I saw and still see, but it's slowed down a little bit. I still see people, just jumping ship. Like, well, I'm in self-storage, but yeah, mine just aren't working right now. I can't find any deals past 6 months. So I'm going to go try flex space. I mean, listen, there's a time for that without a doubt, but the people that are really making an impact and growing their business, they're staying in their niche. They're not getting blinded by what's going on. They're not freaking out about what's going on with their portfolio. They're just doubling down and they're going harder in their niche. They're learning things. They're failing, which is good. But, you got to stay in your niche. And I'm seeing it on my end. I've had some shiny object. I've talked about it. Some shiny object syndrome, I guess. But we've been doubling down on our storage business. And without a doubt, our operations are, even a year ago, 2 years ago, it's gotten, to me, twice as better each year. And it's crazy how far we've come and still room to improve. But that's because we've stayed in our niche and we haven't gone elsewhere to, I guess, see if the grass is greener somewhere, because most times it's not. I've also seen, it's really interesting. I'm also seeing gurus, people in education space, their deals aren't working out. So they're like, you know what? I'm just going to teach this. Nah, I don't know. I have a lot to say. I have a lot of thoughts about that. There are definitely great educators out there in any space, whether it's self-storage, multifamily, fix and flip, wholesale, whatever it is. There are great educators out there. There are also people out there that couldn't do it, so they decide to teach it. I have some thoughts on that. All I'm going to say is do your due diligence before you reach out to somebody. Feel free to reach out to me for, I guess, some off the record opinions, but be careful. There's a lot of great information out there, a lot of great educators out there in any space, but I am seeing more people kind of get into that, especially the ones that there are some that are still doing deals, but there are some that are like, you know what, I'm not good at doing that. Can't do deals. I can't operate, so I'm going to teach. You just got to be careful. It's about as far as I'll go with that. And if you're hanging on to this episode, I appreciate it. We're 20 minutes in. Just listen to me. Appreciate you listening. Sometimes I feel like I'm rambling, but I do feel like there's some decent points here. And just talking to a lot of this isn't my opinion. Some of it's my opinion, but a lot of it's not. It's just data collected over the years of being in other groups and talking to other investors and kind of seeing kind of what's going on and what has happened. Kind of my last thing here, and then we'll get into what you can do going forward. But from what I'm seeing, and I do not raise money. And when I talk syndicators are people or companies that raise money to do deals. So the way I've done my deals is either with my own cash as a down payment. We'll keep it at that. We'll keep it simple as that. I've used my own cash for down payments. Syndicators will either raise money for the down payment, so they're not using their own money, or they're raising money for the entire deal, which is possible too. And whether you're going to private investors, small investors, or you're full blown kind of advertising it, kind of like a Grant Cardone, you're still a syndicator. As long as you're borrowing money, raising money from individuals, you're considered a syndicator. And from what I'm seeing with those people, it's gotten harder to raise money. The good ones are still doing it because they know what they're doing with the deals. They're probably signing up for better debt, and they're really good at operating. So those three things. And I think operating is the one thing I know it's the most overlooked. But the people that are doing them really good job and don't have to fight as hard to raise money are the really good operators. The people that are having troubles are usually the people that aren't operating as well. I'm seeing it without a doubt firsthand. Now, finally, what you can do, and I've kind of talked about it, and I think this is in any market, whether it's a hot market, cold market, middle of the road market, and we'll use storage as an example. Storage is probably in a down market right now. And this is because storage does really well in really good times. So when people have excess money, right, they can buy extra junk. Now they need a place to store it. They maybe buy a bigger house, so they're moving, or they're just moving in general. They're moving up in a way. So they need to store their items for a certain period of time. That's in good times. Bad times, people have less money, have more stress, and then there's more kind of negative things that happen. So then people need to downsize. There could be more divorces. There's just more kind of negatives going on in a bad economy. So now people need to store their stuff, right? Whether that's they're downsizing, divorce, or whatever it is. It's just kind of storage is good in really good times and good in really bad times. We've been kind of in the middle for a few years, I believe, my opinion. So storage is, you really need to be a strong operator right now. And we've learned a lot along the way. But what you can do is right now is obviously pay attention to your operations And that includes everything. That includes rent rates. That includes street rates. That includes, and I just did this yesterday, actually. I just added, we had 5 outdoor parking spaces at one site. Site's not doing the greatest, but the parking is full. So I'm like, well, we could make another $200 to $300 right there per month. It doesn't move the needle much. This site is a smaller site, but it helps, right? And just doing things like that, trying to think out of the box, can help you. But the biggest thing is focus on your niche. So I'm in self-storage, and as I just said, it's kind of a down market, but I think this is a great time to just double down, find deals, and double down on our current deals. Because then when everything comes back, it's just going to be that much better. But I see a lot of people just jumping ship. So one thing you do is double down on your niche. Find your niche, find out whatever it is, stay in it, have great operations, which I see a lot of people kind of, I think they do, but don't necessarily. And I'll tell you a little story, and I know I'm kind of rambling here. I'll tell you a little story that's interesting for us, and it's gotten me really excited. Our team has grown tremendously. In fact, we can kind of say it's more than doubled in the past month. But we've got leaders on the team that have, without a doubt, stepped up and have basically taken all of operations off my plate. Now, when I say all, I'm still in charge of rent raises, and that's about it. Marketing, I guess, too. So specials, which I visit once a week. So I'm out of the day-to-day operations for the most part. I'm thinking, and even with these things, I'm thinking more in the global picture. I'm trying to help guide and lead our team, but we've got great leadership on our team, and they're taking care of all the day-to-day operations, which has helped me focus on our global picture. And it's interesting because we've had 2 team calls where my district manager ran the calls, and I was basically a guest on the calls. It's an interesting space for me, but it's absolutely awesome, and it gives me chills thinking about it, because I know the person doing that and the people on the team as well are growing, have grown, and they're leading the ship. They're steering the ship, especially with the day-to-day operations, and it's going great. That allows me to focus on what I'm good at, and looking at the overall global picture, trying to grow the company, find more deals, those type of things. So I think, again, this is because we've doubled down on what we're doing on our niche and operations. And with that, another piece that you can do right now is, in my opinion, hire quality talent. I think there are people out there, high quality people, that, for a lot of reasons, I think job market is part of the reason, but I also think like AI, there's just a lot of factors out there where there's a lot of talented people out there. And to me, you need to pick them up. You may have to pay a little bit more than what you'd like. And I would say for our team, I hope the people on our team agree with this, but I would say, I don't want to say they're overpaid, because in my opinion, they're all super valuable and investment. But to other people, they may say, well, you're overpaying them. I could pay someone half this amount. You could, but you're not going to get the same type of quality. So we've been really focused on that, is making sure our people are taken care of. Hopefully they feel that way. But making sure they're taken care of, and in a way overpaid. Again, I don't feel like they're overpaid. I feel like they're an investment, and they're super valuable. They're invaluable. So it's worth it. So that is basically all I've got. These are the things that I'm kind of seeing going on in the market, kind of happening in the past couple of years. I do think, especially in commercial real estate, well, residential too, I do think, one, you should buy at any point in the market. You can't time the market. And I didn't say that at the beginning, but you can't time a market. So you always got to be looking, always got to be buying, always got to be taking action. But I do think things will start to look a little bit better here. And I guess when I say that, I mean interest rates. And maybe if you're working on some deals, maybe a quarter point, half point will get you closer to making that deal work. but there's still ways to get it done. So if you've listened for this long, I appreciate it. We're half hour in of me just blabbing. But again, appreciate everyone listening. If you find this show valuable, please share it. We are growing, which is absolutely awesome to see. We're getting new viewers, but also want to have new guests. So if you want to come on the show, feel free to reach out. You can go to our website, thedomorepodcast.com. I'm on social. You can reach out to me. We'd love to hear from you. Love to hear your feedback. And if you want to come on the show, let me know. We'll see you guys next time. Thanks for listening.
Thanks for following, subscribing, and listening to this episode of the Do More podcast hosted by John Farling. To learn more or ask questions, go to l4investing.com.